Chapter 6, in Advanced Accounting, we're going to skip the section that covers the variable interest entities, so you don't have to worry about reading that or working any of those problems. But we are going to talk about their intercompany investments. So if the one company has bonds and then the other company buys those bonds back. So normally what happens in the problems is that the one company is going to have bonds that they sold out to outside parties, and then maybe the parent company can get a lower interest rate. So they're going to go out and they're going to buy those bonds back from outside parties and effectively retire that debt so that it saves some interest. So we've got, if a parent company has issued bonds, $200,000, 10-year, 8% bonds, and they issued those at a premium to the outside parties at 105%. They pay interest annually on January 1st. Then if the subsidiary goes and acquires 50% of those bonds at 102%, we always assume straight line amortization of any premiums or discounts, which makes the problems a little bit easier. And then they tell us in this problem that they give us the subsidiary had common stock of $60,000, retained earnings of $40,000. There was no acquisition accounting premium assets to deal with. The parent had $50,000 of income from its operations prior to any adjustments and after recording their interest expense. The subsidiary company has $30,000 of income from its operations after recording the interest income, and they didn't pay dividends. So again, excuse me. It's trying to get us to focus just on the debt, which I do think is the most important in this chapter, is to just kind of understand the debt. So what I always do in the first place is kind of map out, well, what does the parent have on their books when they issued the bonds, and then what does the sub have when they buy them back. So on the parent's books, when they issued the bonds, they would have recorded the following entry. So they would have, again, they're 200,000 bonds, $200,000 worth of bonds, and then they were at 105%. So 200,000 times 1.05 tells us that they would have received cash for $210,000. They would have set up a bonds payable for $200,000, and then they would have recorded a premium for the $10,000. Then at year end, they're going to deal with the interest. So they're going to have interest expense. They're going to amortize out this premium, and they're going to pay out the interest. So our premium is the easiest one to start with. So it's a $10,000 premium. If we go back to the problem, it tells us that they're 10-year bonds. So then that's, again, fairly easy. Take your $10,000, divide it by your 10 years. We're debiting the premium because, again, when we initially set it up, it's a credit. Now we're amortizing it out over the life of the bonds. So we're going to debit it. Then the cash is the other one that you can calculate out. So you go back to the problem, it says these are 8% bonds. So if they're $200,000 as our par value, and they pay 8%, that's going to be $16,000 that they'll pay in interest each year. So then the difference then between the premium and the cash is going to be what their actual interest expense is. So it'd be $15,000 that they would be charging out in interest expense. So that would have been on the parents' books, again, at 100%. Then if we come over and say, okay, well, what about when the sub goes out and buys them? So the sub purchases, but they don't purchase them all. They purchase 50% of the bonds. So then they're going to come in and say the entry that they make they're going to set up a bond investment, or it could go, to like an equity investment of bonds or something, because again, it deals with the investment between the two. But they're going to go into this bond investment account, and they are going to record their 50% purchase of these bonds, and then they're going to pay the money for them. So again, 50%, they tell us 50% of the bonds for 102%. So that would be $100,000 of the bonds, because here was $200,000. At 102% is going to be $102,000. Now they don't have a separate premium, but they are going to have to amortize that extra $2,000 that's in there. So then when we come down to theirs at year end, they're going to receive the cash. They're going to have to amortize out this extra $2,000, so they're going to have to credit that bond investment. And then they're going to have interest income. So the cash, again, will be, if you look over here, they're paying $16,000 out for 100%. So then they would, if they buy 50%, they're going to receive $8,000. Again, 50% of that total amount of $16,000. Then we go up to the bond investment, that extra $2,000. It is now 5 years later. So these were issued in 2008. These are bought back in 2013. So that means we have 5 years remaining. So then now we take that extra $2,000 and we divide it by 5. So that would give us a $400 amortization. Okay, let me scoot you that a little bit. Okay, so $400. Then the interest income is going to be the difference between those. So it's going to be $7,600. Now then if we take it kind of one step further to look at it to say, okay, well, did they have a gain or a loss? So I like to kind of map this out so that we know what's going on kind of behind the scenes. But then we need to look at it to say, okay, well, when they purchased it, did they have a gain or a loss? So if I can kind of slide that in down below here. If we go to the book value of the parents after 5 years, there would have been the $200,000 of bonds. Then the $10,000 of premium would have been halfway amortized. So that would leave us with another $5,000 left to still amortize out. So our book value would be $205,000. And then again, though, it's only 50%. So we need to multiply that by the 50%. So that leaves us $102,500. Let me see if I can get that to go down a little bit so you can see it. Okay. So then we compare that, though, to what they paid. So if we go back up here and we say, okay, the purchase price by the sub is $102,000. Whoops. If we look up there at what they paid. So then we would have a $500 gain. So then you kind of want to do that work also to figure that out, and that is one of the things it asks us for. Compute the amount of the gain. So it would be $500, and then again, though, this is helpful to have this mapped out because when we go to do our journal entries, we're going to deal with some of these entries, these amounts. So I'm going to go over and move my camera over here. So then when we get to our journal entries, that's ultimately what we're trying to get to say, okay, when we come into our consolidating entries, the textbook does it as one big one. There's a kind of a glare on the screen there, I'm sorry. But so then it's an I entry and with a little subscript of a bond. But so I kind of do it in 2 entries. So hopefully, but you can combine it into one if that makes more sense to you. But what I do is I take the first issuance to say, okay, we got to take these bonds off the books. Not all of them, but 50% of them have to go off the books because they're not owned by outside people. So then we're going to take the bond payable, again at the 50%, which would be $100,000, and take that off of our book, so we debit it. We're going to take the bond premium, what is left, at 50% after 5 years again. So remember that it's after 5 years. So it started at $10,000. It would have amortized down to $5,000 after 5 years, and then now 50% is the $2,500. So those are debits, taking them off the books. Then we come over and we credit this bond investment that the sub set up. So then the bond investment is set up at $102,000, so we credit that out in total. So then you can see our difference is our gain. And then we have to, because the gain is not recorded anywhere right now on the books, we're setting that gain up. Just in the year of that the sub buys those bonds back. So then that's the only place it's getting recorded, is there. Okay, then what I do, again, which is a separate entry, is I do the interest. So, I mean, it's still kind of the bond, but I mean, maybe if you can get it to be a subscript to bond interest, but you can even leave it as the subscript to the bond if you want to. But then I focus back on the interest side and I say, okay, well now 50% of that interest expense and income is being moved between the 2 companies, so we have to eliminate it. So to eliminate our interest income, I need to debit it. And then I'm going to leave some space. Then to eliminate my interest expense, I'm going to credit it. But again, my interest expense is going to be at 50% because only 50% of the bonds were bought by the sub. But the whole interest income will be eliminated. So I look back at my entry and say, okay, my interest income entry that the sub is making is $7,600. The interest expense that the parent is making is $15,000, but again, I'm only eliminating half of it. So that is $7,500. So then we have a difference there, but the difference relates to the amortizations. So then I want to eliminate those. So if I go back to my bond investment, because up here I'm eliminating it completely. Now I know at the end of the year they amortize it for $400. So I'm going to debit that. Now again, if you were putting these all together as one entry, you could net them. And that's kind of how the textbook would do it. It's going to take that minus that, and that would be the net credit. But to me, it's a little bit easier to piece it out into 2 separate entries. I mean, you get to the same place. You just have, like a double entry to that bond investment. Then when you come over to your bond premium, again, half of that bond premium, it's being amortized at $1,000 in total, so 50% of that is $500. Then now you can see, though, your debits equal your credits. We've eliminated our interest income against half of our interest expense. We've eliminated our bond investment against half of those bonds outstanding because half of them still legitimately are outstanding to a third party, so those we want to leave. We don't want to eliminate those. We only want to eliminate what is between the two parties. So then that will be the entries that you have to do. And then again on the test, I'll have it like that, where you got to map out what does the parent record, what does the sub record, what are their interest and expense and income entries, and then what are your consolidating entries. When we do it in Excel, you will have to do a whole worksheet. But on this particular problem for the test, I don't take it all the way to the worksheet. I just stop with these entries. So if you can understand what I've mapped out here, you should feel fairly comfortable.